This is Lisa from Funding Circle. Thanks. Let's welcome her.
So I'm Lisa Griffiths from Funding Circle. Funding Circle is an online exchange where investors can lend directly to small businesses. So we launched in the UK in August 2010, and we launched in the US in October of last year. We've lent about $500 million since we launched in the UK. That's globally across both platforms. And we expect to lend about $600 million across 2014. So what I'm going to talk to you about today are the two questions that we get asked the most. So how scalable is this? We're starting off from quite small volumes. We've grown so far about 2.5 times each year. But what does the future hold? And then secondly, what does our credit look like? So how do we credit assess, and what has been the performance of that to date? So this is our growth to date. So you can see we started off in 2010. We did about, this is all in US dollars, so we did a small amount in 2010, about $3.3 million. And then we've grown each year about 2.5 times. And now in 2014, in the first quarter, we did almost $100 million, which is more than we did in the whole of 2012. So like the other platforms, we are gaining traction, growing very fast. Now we think this is sustainable, and we think these growth rates will continue. And the reason why is a couple of things. So the first thing is, as in the US, these markets are huge. So we think there's about $10 billion worth of lending each month in the UK to small businesses. So it's a huge, huge market. And we think that we will capture more and more of that market because we offer a better proposition to borrowers than what they can find elsewhere. So about 90% of lending in the UK to small businesses is done through 4 big banks. And what you can see there is that the process is slow, it's pretty inefficient. You have to go in branch to actually meet the bank manager to talk about the loan application. But what we see from the feedback from our borrowers is that they really enjoy the experience with Funding Circle. It's fast. You know, on the left, you can see that the NPS score, so how likely the borrower is to recommend us to another borrower, is 90% versus the high street banks who are actually in the negative numbers there. And the reason is like the speed, firstly, but also the transparency. So about 77% of businesses would come to Funding Circle first for a loan before going to another provider. And so not only are we kind of continuing to grow in this market and acquire new borrowers, but those borrowers are coming back to us and continue to come back to us again and again. And to bring this to life a little bit, if I talk about one of our borrowers who has party boats, which they run up and down the Thames. So in London, the Thames divides the city, and there's lots of nice sights along there. So you get people going on these pleasure boats kind of during the summer, seeing the Houses of Commons, seeing the London Eye. And they came to us in May for a loan, and they wanted to buy another boat to run up along the Thames during the summer when it's their busy time. And they came to us, and they went to a bank at the same time. Now, we turned the loan around, said yes, got it back to them. Within a couple of weeks, they bought a new boat, they had a great summer, doubled their revenues. The bank came back after the summer and said, yep, we'll give you the loan, by which point, obviously, the opportunity has passed. And so a lot of businesses are coming to us really because of that speed aspect. And then to move on to the credit side, so how do we actually make sure that the businesses who we put onto the platform are good quality? We combine both data analytics as well as a manual risk assessment. So the first 2 stages, the boundary model and the credit model, are all driven by data. So we've got some big data models there. We have a credit analytics team in-house who are constantly looking to develop these, improve these, bring on additional data sources where they're predictive. But then we always do this final stage, this manual assessment. And we have a team of credit underwriters who have been with banks, with asset finance companies, who run through each of the loans before they go onto the platform and provide that extra check. And then it goes onto the platform, and the majority of the loans get funded. And this is what the result of that is. So this shows you what the credit performance of our book has been on a cohort basis since inception, actually. So the first chart on the top left is our 2010-2011 cohort. There's about $30 million of lending there. The red line shows you what our expectation is in terms of the credit that we would in terms of the loss rate that we would have expected from those cohorts. And you can see it's the loss rate net of recoveries. So the first cohort, we'll take that, we didn't do a great job of keeping to the line. But actually what you can see as we've brought in our modeling techniques is over time, we're starting to get much closer towards that expectation line. And so you can see in 2012, the first half of 2012, which is the top right bracket, we actually introduced an additional credit risk band, which was a lower credit than previously, C risk band. But we're tracking against that line and against the expectations. And this is our actual experience today. In the second half of 2012, we did about $50 million. And again, we're tracking against that line. And first half of 2013, it's early days on that. The months on books is only about 10 months on average. But you can see we're starting to track along this line again, along the expectation. So what we think that means is kind of from a funding cycle point of view, we're operating in a huge market. We think we'll continue to scale in that market because we're offering a better proposition to borrowers, and borrowers are coming back to us again to borrow their second loan, to borrow their third loan. We're also managing the credit risk very well. So all our credit process, our data models, as well as that manual overlay, are resulting in very good credit performance. So that's it. If you've got any questions, I think, do we have time now? We have a bit of time for questions now, and then if you've got any others, then catch me afterwards. So we have a range of different ways in which we source borrowers. So there's some online channels, some offline channels. It's kind of what you'd expect with these types of businesses. I'm not going to give you the breakdown of all those channels because we kind of be giving away our secret sauce.
Let's thank our speaker.